So the mortgage industry was lying to us. Now is our time to lie back to the bureaus. Not saying it's right, not saying it's wrong, but that's the way the system is. And so if I come along and add you to a credit card this and this, and you're this young, you can have credit before you're born or at when you're born or when you're a little baby, and it will increase your FICO score. So far today, it still works. 50% of the time it does not work. It worked with Experian, but I've seen it always work with the other two. So until then, let's go for the ride. You're right, it's not right, it's a major white lie, but so far they're accepting it. But now though, full financial package, verification, income check, credit check, and it's also based on scores. But a lot of these lenders still don't know that authorization access can give you a quick boost in your FICO, a permanent boost in your FICO. So that's kind of what they mean by, these are the type of major trade lines you can have on a report: real estate loans, installment loans like car loans or student loans, and of course revolving. Okay.
Did you see anything about history in this stuff, like how long you have?
Well, on number 4 on this page, you mean length of credit history?
Yeah, was that part of the 3 rule, 3 years or something?
Well, it is. Oops, right there. So, the 3 and 3 mean that this is a combination of 3 or more trade lines on a report that lenders would like to see, but really 3 or more years of history they like to see on a report. It says that you're creditworthy.
I thought it was 2, like for lenders, for example.
Might be 2, might be 4. This is just general. Yeah. These are the 3 major credit bureaus. Does anyone know what the 4th one is? It's called Innovis, the CVC Innovis. It's actually a European company, but no one pays attention to them. Equifax, Experian, which was formerly TRW, and TransUnion. Most lenders take the middle of your 3 scores to determine what that is. Has anyone looked at a credit report, the ones who are in real estate or personally or a family member? You run a credit report and the score is missing, or 2 scores are missing, it says NA. Why does that happen? What is it? Jose, what do you think?
I have no idea.
Stu. Okay.
Yeah.
Scores will disappear due to a lack of fatness on the report. Meaning there's not enough open trade lines. It's too thin to capture a score. It's like saying that, whoops, if this water was a block of ice, I can easily pick it up and carry it out. But if it melts into water, I can't scoop it up with my hand, or eventually it's going to evaporate. So you have to have more solid information on a credit report. Meaning that when it gets too thin, or you have no open revolving, remember revolving makes up 1/3 of your FICO score, no open revolving, not a check card by the way, and everything else is closed out, or they're older collection accounts. It can't rescore, it can't capture a credit score. That's why it says NA or NA. So what's the biggest ticket of success long-term to have FICO scores? Revolving. You gotta have revolving. See, earlier we were talking about real estate loans. Real estate loans are actually very healthy for your credit. In fact, the higher debt you have with first mortgages, it makes your scores go up. If you want to get to 800, you have to have a mortgage of at least $150,000. So it'll stop like at $799. If all payments are made on time, of course. In today's market, people have lates in foreclosure. But installment really does not make much of an impact because it's a controlled debt environment. You get a car loan or student loan, like a pair of stairs, last payment goes away. Revolving is like a roller coaster. Use it again and again, low debt, high debt, pay it off, use it again. So it stays open. This gives you more success with higher credit score. Because if you had a $10,000 automobile loan and a $10,000 maxed out credit card, you get more FICO point gain by paying that off. See, I had a client one time where he barely had 3 trade lines and he paid off his car loan. His score dropped. Again, it might be 2 years, might be 3, who knows, but it changes every year on the requirement with Fire Isaac, let alone the human element when it comes to approval of a loan. But it depends on how many trade lines that person has and the condition that they're in. This is good information. I think visual speaks 1,000 words. According to Fair Isaac, you increase a national FICO score by only 10 points. You can reduce a national mortgage by $100 a month. National. Of course, it's for California, more or less than the East Coast. So imagine going up, 100 national, going up 100 national FICO points and bring your mortgage down $1,000 a month. That's a lie. Because, pretty common sense, the higher credit score you have, you're going to get a lower rate, lower payment. Make sense? Based on the APR. Credit bureau activity. Credit bureaus are neutral territory. They maintain information consumers report. By the way, according to Fair Isaac, what percentage of mistakes do you think are on our credit reports?
92%.
Huh?
92%.
Pretty close. Anyone else? About 86%. And the two biggest reasons are this, identity theft, which is a growing problem. The Secret Service are very involved, more than protecting the president, and mistakes. And that's where we're successful getting credit cleaned up because of the mistakes. I don't care if the account is completely your fault, like I'll show you just a quick example. If something is completely your fault, that under the error of that account, like I had this Macy's taken off someone's report because they misspelled the word Macy's, they tried to put the apostrophe in the S. So it came off the person's report. I'll show this to you in a little while. So people think, okay, here's you, this is the credit bureaus, these are the creditors. If you owe a creditor $5,000, it's in collections, and I erase it, delete it from the credit report, they think that they no longer owe that creditor that $5,000. Maybe or maybe not, depends on the statute of limitations, that's of course for another class. But if it's only a 6-month-old debt, it got into collections, let's say January of this year, it's a fresh debt. And removing from the credit report's not that hard, which I'll show you some samples in a minute. But you still may owe the creditor that money. See, credit bureaus are like children. The creditors are parents. The parents tell the bureaus what to do by reporting the information. And when it comes time to verification time, the children must ask the parents, is this correct? Under an 18-point, I'll talk about that shortly. So if you owe a debt, or certain kinds of debt, Christine and I were talking about certain nonprofit organizations, Operation Hope or United Way is coming up with a program right now where they're trying to help people with free credit repair. But they say, okay, here's the information, do it yourself. Do you know if you have a collection account, let's say you owe $1,000 on 5 years ago, it's on the credit report, it says data last activity 2000, let's say 5 years ago. Well, by law, federal law, in 2 more years, it's going to come off the report. After 7 years, good or bad debt, or good or bad account, it's got to be removed by federal law. It's outdated. So if it's been sleeping for 5 years, and these do-it-yourself nonprofits tell us, your client, this is how you're going to fight this negative item. And the professional said, hey, there's a 4-year federal statute of limitations to pay that debt. Well, legally, you don't have to pay the debt. But if they dispute it in a wrong way, they're going to wake it up. And they're going to renew 5 of those 7 years. So instead of it, for example, coming off in the year 2012, it'll come off in the year 2015. You just renew how old it is and work it up. Does that make sense? So you have to be careful how you look at old accounts. And how can you tell in your own report? Look at the DLA, date of last activity. If it's 2 or less years from today's date, do whatever you want. Tell them to stake it, pay it off, settle it, do something. Because a lot of lenders, even in a hot economy, says, surely pay off that debt. And they don't know, because based on the debt-to-income ratio, getting that mortgage, it's 5, 6 years old, you pay off the $1,000 and renewed that 5 of the 7 years, your score just dropped 60 points. Well, what happened? They don't know themselves. So be careful how you walk through your credit report when you look at someone's report, and we looked at the data last activity on that report. It says 5 years ago, be careful. And a lot of these loan officers didn't know you can use escrow. Escrow is neutral territory. Everyone knows what escrow is. You put your down payment fees in there. Well, Mr. Bank, I'll take the $1,000 that I owe, put it in escrow, neutral territory, doesn't get reported to the bureaus yet, and you know that the debt's going to be paid. So close my loan today, and 3 days later, rescission period, a week later, take the money, wire it to the bank, whatever it is, the debt, pay it off. Because if I got my loan last week, right to cancel's already passed, my score drops 80 points, who cares? Because really it's you're stuck between a rock and a hard place, slang. Okay, meaning that if you go this way or that way with that debt, you're going to hurt yourself. So what do? Use escrow. People didn't know this back then. They lost some really good loans in a hot economy.